Silver has always been known as the poor man's gold, but have you ever looked at the price charts and felt like something was missing? The numbers don't always match the physical reality of the market. For decades, investors have whispered about market manipulation. They talk about big banks and shadowy figures behind the scenes. Most people dismiss these stories as simple conspiracy theories. But what if the evidence is actually sitting right in front of us? Let's look at how the silver market actually functions. It isn't just about bars of metal sitting in a vault. The paper market for silver is actually much larger than the physical one. In fact, the ratio of paper silver to real silver is staggering. Does it make sense that more silver is traded than has ever been mined? This is where the first red flags start to appear. Large financial institutions hold massive short positions on the metal. When the price starts to climb, these positions often get even larger. Have you ever noticed how silver prices often crash in the middle of the night? These sudden drops happen when trading volume is at its lowest. It's a classic tactic used to trigger stop-loss orders. When those orders hit, the price tumbles even further. The big players can then buy back their positions at a much lower cost. It happens so fast that most retail investors can't react in time. You might wonder if the regulators are watching these moves. Over the years, several major banks have actually been fined for this behavior. JP Morgan Chase paid a record settlement for spoofing the precious metals markets. Spoofing is when traders place orders they never intend to execute. It creates a false sense of supply or demand to move the price. Even with these fines, many believe the practice hasn't stopped. The profit from the manipulation is often much higher than the penalty. Think about that for a second. If the fine is just a small fraction of the profit, is it really a punishment? It looks more like a cost of doing business. The silver market is relatively small compared to gold or oil. This makes it much easier for a single entity to influence the direction. Industrial demand for silver is currently at an all-time high. It's used in everything from solar panels to electric vehicles. Usually, high demand leads to much higher prices. But silver seems to stay stuck in a specific trading range. Is the price being suppressed to keep industrial costs low? Many analysts argue that a true silver price would break the current system. If silver jumped to its historical ratio with gold, the impact would be massive. Central banks don't like it when precious metals outperform fiat currency. It makes the dollar look weak by comparison, so there is a clear incentive to keep these prices under control. Look at the COMEX inventories lately. Registered silver stocks have been dropping at an alarming rate. Physical silver is moving out of the vaults and into private hands. Yet the price on the screen barely moves an inch. It's a massive disconnect between supply and demand. How long can the paper market ignore the physical shortage? The pressure is building behind the scenes. The gap between physical silver and paper contracts is widening every day. You have to ask yourself who actually owns the metal in those vaults. Most silver contracts are settled in cash, not physical delivery. This allows the market to stay inflated with digital silver that doesn't exist. When someone demands the actual metal, the system starts to sweat. We've seen delivery delays becoming more common in recent months. Wholesalers are reporting premiums that are much higher than the spot price. If you go to buy a silver coin today, you'll pay way over the market rate. This is the real price of silver, regardless of what the exchange says. Why is there such a massive difference between the two? It suggests the spot price is being artificially held down. Large banks use high-frequency trading algorithms to keep the lid on. These bots can trade thousands of contracts in a fraction of a second. They create walls of sell orders that discourage any upward momentum. It's like trying to run underwater. Every time the price gains speed, it hits a barrier of paper selling. Look at the timing of these price dumps. They almost always occur right before the market opens in New York. This is when the maximum number of traders will see the drop and panic. Fear is a powerful tool for controlling a market. If people think silver is a bad investment, they won't buy it. This keeps the demand for physical metal from exploding. But the industrial world can't just stop buying silver. Manufacturers need it for conductivity and chemical stability. They can't replace it with a digital contract. Eventually, the manufacturers will bypass the exchanges entirely. They'll go straight to the miners to secure their supply. When that happens, the COMEX price will become irrelevant. We're already seeing signs of this happening in the solar industry. Silver inventories in London and New York are being drained. Where is all that metal going? A lot of it is moving to the east, specifically to India and China. These countries have a much different view of precious metals than the West. They see silver as a tier 1 asset and a store of value. They're happy to buy it at these suppressed prices. It's effectively a massive wealth transfer happening in plain sight. Western investors sell their paper while Eastern buyers stack the metal. Do you think the banks don't realize what's happening? They know exactly how much physical silver is left. They might be keeping the price low to finish their own accumulation. It's an old game played by those with the most information. If you wanted to buy a massive amount of something, would you want the price to go up? Of course not. You'd want the price to stay as low as possible for as long as possible. The manipulation isn't just about making the metal look bad. It's about controlling the exit door of the financial system. Silver is one of the few assets that isn't someone else's liability. In a world of soaring debt that makes it very dangerous to the status quo, the proof of manipulation isn't just in the lawsuits, it's in the math of the physical market versus the paper one. The math simply doesn't add up when you look at the total global production. Mining companies only pull a certain amount of silver out of the ground each year. Most of that silver is a byproduct of mining for copper or lead. This means miners can't just increase silver production because the price goes up. They are stuck with whatever comes out of the primary mine. At the same time, silver is being used up in industrial processes. Unlike gold, which is mostly stored in vaults, silver gets consumed. It's in your phone, your laptop, and the switches in your house. A lot of the silver is never recovered through recycling because it's too expensive. So the total supply of available silver is actually shrinking over time. Yet, the price behaves as if there is an infinite supply. How is that possible without some form of intervention? The answer lies in the massive piles of unallocated silver accounts. When you buy silver at a bank, you often don't get a specific bar. You get a promise that the bank holds silver on your behalf. But these banks often use the same bar to back multiple accounts. It's a fractional reserve system for precious metals. If every account holder showed up to claim their metal, the vaults would be empty. This realization has led to the silver squeeze movements we see online. Retail investors are trying to force the bank's hands by taking physical delivery. They want to see if the metal is actually there. What happens when a bank can't fulfill a delivery request? They usually offer a cash settlement instead of the metal. But if you wanted the silver, a check for the paper price isn't the same thing. It proves that the physical market is detached from the financial one. Have you noticed how often the silver to gold ratio fluctuates? Historically, the ratio is around 15 to 1. In the modern era, it is blown out to 80 to 1 or even higher. Geologically, there is only about 8 times more silver in the earth than gold. The current price ratio makes silver look incredibly undervalued, or it suggests that the gold price is also being managed. Either way, the discrepancy is a glaring sign of a distorted market. Whistleblowers from inside major trading firms have described how it works. They've talked about concentrated short positions held by just 4 large banks. These banks have enough power to move the needle whenever they want. If the price breaks a certain level, they flood the market with sell orders. It's a psychological game played against the small investor. They want you to get frustrated and sell your holdings. They want you to believe that silver is a dead asset. But why would they spend so much energy controlling something that doesn't matter? You don't manipulate something that has no value. The very existence of this manipulation is proof of silver's importance. Every time the price is suppressed, the eventual springback becomes more violent. Think of a beach ball being held underwater. The deeper you push it, the faster it will fly up when you let go. We are seeing the pressure build as the physical supply gets tighter. The big banks are playing a dangerous game with a finite resource. Eventually, the physical reality will override the paper narrative. And when that happens, the price discovery will be legendary. Wait until you see how the clearinghouses actually handle a default. They have rules in place that allow them to settle in cash during an emergency. This means the exchange can literally change the rules in the middle of the game. If they don't have the silver, they just give you the devalued currency instead. This protects the big banks from ever truly losing their shirts. It's a rigged deck, where the house always has an escape hatch. Have you ever heard of the London Bullion Market Association? The LBMA is the center of the global wholesale silver trade. In early 2021, they admitted to a massive clerical error regarding silver stocks. They originally claimed there were thousands of tons more than actually existed. How does a multi-billion-dollar organization make a mistake that large? It happened right when retail investors were buying up every ounce they could find. The error made it look like the market was well supplied, when it was actually bone dry. By the time they corrected the numbers, the buying momentum had cooled off. Was it really just a typo? Or was it a strategic move to prevent a price spike? Many veteran traders believe it was a deliberate attempt to mislead the public. If the truth about the low inventories got out, the price would have doubled overnight. The system simply cannot handle a true price discovery event. Most of the world's silver is tied up in leases between banks. Bank A leases silver to Bank B, who then sells it to the market. Now, 2 different entities think they have a claim to the same silver. This creates a massive web of overlapping ownership. It works fine as long as nobody asks for their metal at the same time. But the world is changing, and trust in the banking system is hitting new lows. People are starting to prefer the weight of a coin in their hand over a line on a screen. The premiums for physical coins tell the real story of supply and demand. When the spot price is $24, but a coin costs $35, what is the real price? The spot price is just a number used for settling paper bets. The $35 price is what you actually have to pay to own the asset. This spread is the clearest proof that the official price is a lie. Don't let the daily fluctuations on the news distract you from this gap. The people managing the price want you to focus on the red and green candles. They want you to trade your silver back and forth for a small profit. They don't want you to take it home and bury it in the backyard. Silver in your possession is silver they can no longer use for their paper games. Every ounce removed from the system makes the manipulation harder to maintain. The miners are also starting to wake up to this reality. Some primary silver miners have begun withholding their production from the market. They refuse to sell their hard-earned metal at these suppressed prices. If the miners stop selling to the exchanges, the paper market collapses. It's a game of chicken between the producers and the manipulators. Look at the massive increase in silver imports to the Middle East recently. Wealthy families there are trading their dollars for physical bars by the ton. They know that physical assets are the ultimate insurance policy. They aren't interested in trading contracts on a digital platform. They want the real thing, and they want it now. The window for buying silver at these managed prices might be closing. As the physical supply continues to vanish, the paper charade becomes more obvious. It's not a matter of if the manipulation ends, but when. And the when usually happens when the vaults finally hit zero. What happens when the world's largest silver exchange finally runs out? It's a scenario that the financial media refuses to discuss. They prefer to focus on the stock market or the latest tech trends. But the movement of physical metal tells a much darker story. In 2022, we saw one of the largest silver outflows in history. And the metal wasn't just being traded, it was being moved into private storage. When silver leaves an exchange vault, it's often gone for good. It goes into industrial products or private collections where it isn't tracked. The official reports try to paint a picture of stability, but if you look at the eligible versus registered categories, things change. Registered silver is the stuff available for immediate trade. That pile has been getting smaller and smaller for years. Eligible silver is just being stored there and isn't necessarily for sale. The banks often blur these lines to make the inventory look larger. It's a shell game designed to keep investors from panicking. Have you ever wondered why silver is so much more volatile than gold? Its smaller market cap means a few big trades can spark a massive move. This volatility is a tool used to shake out weak hands. If the price drops 10% in an hour, most people get scared. They sell their positions and vow never to touch silver again. That's exactly what the manipulators want to happen. They need you to be afraid of the asset so they can control the price. But if you look past the volatility, the long-term trend is clear. The fiat currencies of the world are losing value every single day. Inflation is eating away at the purchasing power of your savings. Silver is a finite resource that cannot be printed out of thin air. It takes years to find, permit, and build a silver mine. You can't just flip a switch and create more supply. This physical reality is the ultimate enemy of the paper shorts. They can print unlimited paper silver, but they can't print the atoms. At some point, the delivery requirements will exceed the available metal. We've seen this happen in other commodity markets before. When the short squeeze happens, the price doesn't just go up. It gaps up so fast that trading has to be suspended. The exchanges will likely lock limit to prevent the price from mooning. They will do everything in their power to protect the big shorts. This is why owning the physical metal is so important. If you own a paper contract, you are just a creditor to a broken system. If you own the metal, you own a piece of the Earth's crust. Honestly, the proof is in the actions of the central banks themselves. They don't tell you to buy silver, but they are hoarding gold at record levels. They know that the current monetary system is on shaky ground. Silver always follows gold, often with a much bigger percentage move. It's the coiled spring of the financial world. The more they suppress it, the more energy is stored for the breakout. Are you watching the COMEX numbers as closely as the banks are? They are watching the exits, waiting for the first sign of a stampede. The cracks are already starting to show in the global silver market. You can see it in the rising premiums and the falling vault levels. The truth is getting harder to hide with every passing month. The mainstream news will tell you that silver is just another industrial metal. They'll say it's no different than aluminum or zinc, but central banks and governments don't treat it that way behind closed doors. If silver were just an industrial commodity, why is it held in secret reserves? Why do the world's most powerful banks spend so much time trading it? The reality is that silver is the Achilles heel of the entire banking system. It represents a way for the average person to opt out of the digital dollar. If the price of silver were allowed to reach its natural peak, it would expose inflation. People would realize how much value their savings have actually lost. This is why the suppression is so coordinated and persistent. Look at the flash crashes that happened during the London and New York crossover. Thousands of tons of paper silver are dumped onto the market in minutes. This is more silver than the entire world produces in several months. No rational investor would sell that much at once if they wanted a good price. The only reason to dump that much volume is to drive the price down intentionally. It's a blunt force trauma tactic used to break the chart's technical support. Once the chart looks broken, the momentum traders start selling too. The banks then step in at the bottom and cover their shorts for a profit. It is a perfect, self-reinforcing cycle of wealth extraction. But this cycle relies on one thing: a steady supply of physical silver. They need enough metal in the vaults to maintain the illusion of a liquid market. Lately, that supply has been moving into private hands at an unprecedented rate. Retail investors are no longer just buying paper silver through ETFs. They are clearing out local coin shops and online bullion dealers. When the retail market stays sold out, the pressure moves up the chain. The dealers then have to demand more metal from the wholesalers. The wholesalers then have to demand it from the mints. The mints then have to go to the exchanges to get the raw bars. Eventually, the demand reaches the very vaults where the manipulation happens. Can you see how the circle is closing? The banks are running out of the very fuel they use to suppress the price. They are essentially selling silver. They don't have to people who really want it. That is a recipe for a massive short squeeze. Think back to the nickel market spike on the London Metal Exchange. The price went up 200% in a single day. The exchange actually canceled the trades to save a major Chinese bank from ruin. It was a shocking admission that the free market is only free until the banks lose. Many believe a similar force majeure event is coming for silver. The exchanges might simply stop trading or settle everything in cash. If that happens, the only people who will profit are those holding the physical metal. A digital promise of silver will be worth nothing in a total market freeze. Have you checked the availability of silver bars lately? Lead times are growing, and certain products are becoming impossible to find. This isn't because the miners stopped working. It's because the smart money is quietly exiting the paper system. They are trading their digital digits for something they can hold. The manipulation has worked for a long time, but it isn't infinite. You can only fight the laws of supply and demand for so long. The proof isn't just a theory anymore, it's a mathematical certainty. The countdown to a real price discovery has already begun. The manipulation goes beyond just the daily price action. It involves the way silver is taxed and regulated across the globe. In many countries, you have to pay a value-added tax on silver, but not on gold. This makes it harder for the average person to build a significant position. It's another subtle barrier designed to keep people away from the metal. Why would governments want to discourage the ownership of silver? Perhaps they recognize its history as the ultimate rebel money. Throughout history, silver has been used to bypass failing government currencies. It's much more practical for daily transactions than a heavy gold bar. This makes silver a direct competitor to the fiat system. The big banks know that if silver breaks out, the dollar is in trouble. They use the paper-to-silver ratio as a weapon of mass distraction. Right now, there are hundreds of ounces of paper silver for every ounce of real metal. It's a giant pyramid built on a very tiny base of physical reality. What happens when the people at the top of the pyramid want to cash out? There simply isn't enough metal to go around. The exchange-traded funds, or ETFs, are another part of this complex web. Investors think buying an ETF is the same as owning silver. But if you read the fine print, most ETFs don't allow for physical redemption. They are just tracking the price, not providing you with the asset. In some cases, the silver held by the ETF might even be leased out to short sellers. This means your own investment could be used to drive the price down. It sounds crazy, but this is how the modern financial plumbing works. The system is designed to favor the house, not the individual. Look at how the media covers silver during a price rally. They usually bring on experts to explain why the price can't go any higher. They talk about excess supply or slowing industrial demand. Yet, they never mention the shrinking inventories in the major vaults. They ignore the fact that silver is a critical component in the green energy transition. You can't build a solar-powered future without massive amounts of silver. The demand is structural, and it isn't going away. Is it possible that the price is being suppressed to subsidize these new technologies? Low silver prices make solar panels and EVs much cheaper to produce. The costs of the green revolution are being pushed onto the silver miners. Eventually, the miners will demand a fair price for their product. They are the ones doing the hard work of digging miles into the earth. The traders in New York are just pushing buttons on a keyboard. Who do you think has more leverage in a real supply crisis? The person with the metal always wins in the end. We are approaching a point where the paper shorts will be forced to cover. When they do, they will all be trying to squeeze through a very small door. This is why we see these massive V-shaped recoveries in the silver chart. The dip buying is becoming more aggressive every time the price is suppressed. The proof of manipulation is written in the desperation of the sell-offs. They are trying to keep a lid on a boiling pot, but the heat is only being turned up by global inflation. People are losing faith in the promises of the banking elite. They are looking for something tangible, something real. And silver is the most accessible real asset on the planet today. The evidence of manipulation isn't just a historical footnote anymore. Recent events in early 2026 have pushed the system to its absolute limit. In January, the silver price shattered records, surging toward $90 an ounce. It wasn't just a random spike, it was a physical run on the vaults. For decades, the paper-to-silver ratio was the invisible hand controlling the price. But when institutional investors began demanding physical metal, the game changed. COMEX data revealed that over 25% of registered inventory vanished in a single week. Traders weren't waiting for their contracts to expire. They were pulling bars out early. This is the ultimate nightmare for a market built on paper promises. If everyone asks for their silver at once, the exchange effectively defaults. Have you ever seen a market move 40% in a single session? That's exactly what happened during the January silver run. The sudden volatility triggered massive margin calls and forced liquidations. Suddenly, the big banks were the ones getting squeezed. They tried to cool the market by raising margin requirements to astronomical levels. It's the same old playbook. Change the rules when the house starts losing. But you can't print physical silver to cover a short position. Global supply has now entered its 6th consecutive year of deficit. China and India have been quietly vacuuming up the world's remaining stock. In fact, China recently introduced strict export controls on silver. They recognize it as a strategic asset for the future of technology and energy. While the West treats silver like a speculative toy, the East treats it like a weapon. The industrial demand from AI and solar power is no longer a forecast. It's a reality. Data centers and high-performance chips require silver for thermal management. Every new technological breakthrough makes the metal even more indispensable. Yet, the official price remains subject to these violent flash crashes. In February 2026, the price plunged double digits in a single day without any major news. Analysts called it a liquidity event, but many physical holders saw it as a desperate raid. It was another attempt to shake out the retail investors who had pushed the price to its peak. But the math is getting harder for the manipulators to hide. The gap between the spot price and the cost of a physical bar is wider than ever. In some regions, the premium to own the actual metal is 50% over the screen price. This is the real price of silver that the banks don't want you to see. They want you to believe that the digits on your screen are the same as the metal in your hand, but you can't build a solar panel or a cruise missile with a digital contract. The world is waking up to the fact that the paper market is a giant illusion. We are moving from an era of price management to an era of physical scarcity. When the vaults finally hit zero, the paper game ends forever. No amount of spoofing or high-frequency trading can create atoms out of thin air. The transfer of wealth from paper holders to metal holders is already underway. Look at the numbers for yourself, and you'll see the pattern. The big banks are being forced to pay billions in settlements for their past crimes. But these fines are just the cost of keeping the curtain closed a little longer. Eventually, the curtain falls, and the truth about silver is exposed to everyone. Are you going to wait for the mainstream media to tell you it's over? By then, the physical metal will likely be unavailable at any price. The proof is real, the inventories are low, and the clock is ticking. Honestly, the only question left is how much silver you actually have in your possession. The paper era is dying, and the era of real assets has arrived. The manipulation was the greatest gift to those who saw it coming.